Hello, income harvesters. Welcome back to the channel. As we are approaching the end of the year, also the holiday season, Christmas, New Year, and so on, uh, it's a time to reflect upon what's been happening over the last 1 year in the markets, in the income space, and also in the other spaces like growth stocks and other opportunities. So here today, I'm going to talk about some new funds which were launched in the Canadian market, and these are more focused on the high income or high yield space. Uh, the funds which I'm going to talk about are funds which invest in a diversified basket of stocks or funds. They would not be single stock funds, and they would not be single sector oriented funds, because uh, the whole idea here is we are trying to invest for the long term, and we want something which is more stable, something like a set it and forget it kind of option, where you can um, invest a little bit every month or every periodical time, and then let it grow over a period of time, and you don't have to do too much of trading or management, or try to manage the fund, because it's already a balanced portfolio and it's already diversified. And one example is the Harvest Canadian High Income Shares. That's one fund. The other fund I'm going to talk about is also a recent one, which is very popular, which is known as the CANY, the Evolve Canadian Equity Ultra Yield ETF. We're going to discuss about these funds. I am going to go through their material since they are very new. Uh, just a quick disclaimer: this is not financial advice. This is not investment advice. So the recommendation is always do your own research before you make any decisions. Okay, so before I jump into CANY and HHIC and how they work and so on, I wanted to give you some perspective about these funds, because we have been observing that there are a lot of new kinds of funds coming up with the newer kind of strategies. Although they do the covered calls, we have seen covered calls for the last 2 years, 3 years. But the newer funds are trying to do it in a slightly different way to enhance the yield. Plus, also they're trying to find out ways to bring new products, new instruments, and new kind of concepts, where you can invest in a single stock or a single sector, or you can buy a whole basket, all these kinds of things. And you also find these products in Hamilton ETFs. You also have Harvest, Evolve, plus various other funds which are coming up with new ideas, like new concepts. The 9 point funds are also coming up. And you find a lot of YouTube videos, social media discussions around these. Just wanted to give you a quick concept on how these funds are, designed, or what types of funds exist, so you get the background, and then we will move into the comparison of these two funds. Okay, first let me talk about this. This is called the high yield platform ETF. Basically, every fund is trying to come up with a kind of a platform, or a kind of a format, I would say. In Evolve, they call it ultra high yield ETFs, and within the Evolve, they also have enhanced yield ETFs. And similarly, Harvest has high income shares ETFs, and in the high income shares, they have one for the US market, HIS, and the one for the Canadian market, which is HIC. And if you look at the Hamilton funds, they have like HDIV, HYLD, and so on. So some of the ETFs, they hold single stocks. Like for example, if you look at MSD, they are holding strategy, and like that you have some funds which hold Microsoft or Apple, or let's say Amazon, and so on. So I don't have this ticker symbols here, but I'm just giving you examples that these funds hold single ticker stocks, which means that you're investing in the stock, underlying stock. Plus, the fund also writes covered call on the same stock, and that stock plus covered call combination becomes an ETF. Just like MST, you have Apple and AMZ and so on, like for Apple, Amazon, Microsoft, all the bigger blue chip companies, including the IT firms, the large blue chip names. They have these single stock ETFs. and these are ETFs run by the fund managers, funds. You can check them out. Yeah, there are people who prefer investing in these. Like they like the single stock plus the covered call combination. Okay, one warning here: like if you're going to invest in a single stock, you still have the risk of holding a single stock. That doesn't go away. The covered call is going to give you a little bit of protection from high volatility. Volatility might reduce, returns can increase or reduce depending on the situation, and the returns are just being converted into more income rather than growth. So you're going to have a trade-off. You're going to you know sacrifice some growth in exchange for more income. That's the concept. And if you go into the sectors or themes, all the above concepts apply, but instead of investing in one single stock, you're investing in a bunch of stocks which are in the same sector. For example, you have the you know ETFs based on the Nasdaq QQQ ETFs, and you have all these QILD, QILG, and triple QI. There are many examples here. So these are actually based on the um, based on the index, or it could be based on the sector. Like for example, you have SIXY based on the six big banks, and you have the bank also ETF. These are examples. I'm not giving any recommendations or any. These are not financial advice or recommendations. Just rough examples. So it could be based on sectors or themes, and even the purpose investments. They launched something called the Batman. You know, Broadcom, Amazon, Apple, Tesla, Microsoft, and so on. So it's a kind of an acronym they used, like Batman, and like the FANG ETFs and so on. So they come up with different names, but make sure that you understand that it is a strategy that is income oriented. What type of strategy they use, and how do they generate income? Is it in the form of capital appreciation? The capital grows over a period of time, or is it like you have a steady amount of income generated by the fund, by writing calls and earning call premiums? So two ways funds can generate income. The one is your covered call premiums. That's the most popular. Like the fund writes covered calls and they generate income. And the other would be the growth in the price of the stock over a period of time. The stock grows over a period of time, and then you benefit from the increase in the prices, increase in the valuation of the companies, increase in the growth in the future. So that those are two ways. Of course, there's other smaller things like, for example, dividends paid by the companies, which come into the funds basket, and then it comes to you indirectly. So that's another form of income that you get. Basically dividends. So dividend growth and also covered call income, premium income. The premium income is going to be the main thing, but you also want to make sure that you get a little bit of growth, because if you don't have the growth, then the fund value is going to dip a little bit because of the high amount of distributions these funds have. So, some kind of NAV erosion is possible, but NAV erosion is not bad. Like it's like saying that a company, blue chip company, paying you more dividends is a bad thing. You're worried about Procter and Gamble giving you very high dividends, and you're worried that the company is not growing. That's actually a wrong way of looking at the concept. That you have to understand that there is a reason why dividends are paid and distributions are made, because the fund is generating income from the covered calls. Similarly, when companies declare higher amount of dividends, there could be different reasons, like they don't have investment opportunities and they have extra cash, and that cash would be more justified to be distributed to the investors. So those are the decisions taken by the company and the management and the board of directors and so on. So now we have the single stock ETFs and sector ETFs, two of them covered. The third item is the most important, the last one, which is in many cases ignored. Like most of the people who follow my channel, like they would be familiar with the third basket more, because you are looking at something which is more diversified. However, even if you're watching my channel and you're looking at sectoral ETFs or single stock ETFs, I'm not saying you're wrong. You have the option to go that route as well. You can take option one and two. Uh, Option one and two work well if you have a view on a particular stock or view on a particular sector. You have done a lot of research and you are able to take that view. And single stock is something which is more risky. I don't recommend to anybody, but it's up to you. Like if you want to go in that direction, you can do that. And similarly, sector ETF approach is also valid. It is far better than going the single stock route. When you go to the diversified route, the advantage that you have is you have a complete basket of stocks across a basket of industries. So you don't have to worry about like which stock I need to pick, which sector I need to pick, and you are more focused on investing in the long term. Some people, um, you know, call this similar to index investing or index passive investing. Different words that people use for that. You're basically investing in a broad basket. So that way you're avoiding all the uncertainty, with respect to single sector or single stock. So diversified baskets are of two types. One is fund is holding different stocks, diversified set of stocks. That's the normal format that we are all familiar with. The second would be one fund holds different types of funds. Like so, let's say Harvest, diversified income fund holds different funds. Like one fund is like banking fund, one is a utilities fund, and the other one is a healthcare fund, and then you have the technology fund. So the on the top you have the main fund, which is holding a lot of sub funds within the same fund house, or it could be funds across different fund houses. So that's like you have one big fund which is like a diversified basket of stocks or a diversified basket of different ETFs or funds. So those are the three ways they do it. And why the name high yield platform is because it also helps them in branding. For example, Harvest ETF, they call it high income shares. Purpose investments call it like yield shares. And other funds, they have different names. Some of them call it like high income funds, or they call it high income products and so on. So whatever name they call it, like you just need to do your own research and find out what is the fund, what is the strategy, what are the companies, or what are the components within the portfolio, and how much I'm investing into this fund, and how much return you can get in terms of distributions, how much return you can get in terms of capital. Uh, so that's about it. Now I'll quickly go to the you know Harvest website as well as the brochure to discuss this HHIC, which is the Harvest Canadian High Income Shares. HHIC is the ticker. I'll quickly go to the product brochure. So I'm looking at my screen to take you walk you through the brochure. Uh, so this is the brochure they have, and yeah, Harvest High Income Shares. This is the name of the platform or the format they have for the high income funds. Uh, Platform would be a better word because on the same platform they're going to launch more and more funds. Probably they're going to launch like dozen funds or more. We never know. Like initially they had only a couple of funds, then they started with three, four, five, six, seven, and kept on adding it. And then later on it became Harvest High Income Shares. And yeah, so it involves two components. One is holding a stock, underlying stock, and doing active covered calls. And let me go down a little bit. Uh, it's income focused and seeking monthly distributions with tax efficiency and exposure to blue chip companies. That's a great point that the fund is making. Like not only the Harvest one, like most of the funds have blue chip companies, but always do your own research. Look at the underlying companies. That's very important. Like you can get 20% yield or 30% yield. That's not the point. You need to also know where you're investing in, where the money is going, and investing preferring a one ticket solution eligible for RRSP and all that, TFSA. Yeah. So that's how the fund works. And the advantage is like I want to just zoom this section a little bit so that you can see this part. Yeah, I hope that is visible now. So the key advantage here is like you get tax efficient income from covered calls, the second point, and you have top single stocks with high monthly income. Because the fund can write up to 50% of portfolio, up to 50%, max is 50%. So the fund manager has the flexibility to decide how much they want to write. If they find that the stock is doing well and has more potential for growth, so they can reduce the amount of call writing or not do so much of active writing. But if the fund managers see that the stock may not have high growth potential, they might, you know, look at doing a little bit of covered calls to generate that intermittent income. And these are blue chip companies, so the chance of one company folding or going under is pretty limited. But at the same time, if something happens to a single company or something happens, you still have 10 other stocks in the portfolio to take care of the growth and yield in the future. There will be an impact if there is one company which is going bankrupt or something happens. However, since the portfolio is diversified, you don't need to worry about losing all your money at once. You may have a little bit of intermittent dips, but you'll be fine over a period of time. Now, the other thing is like you have a lower purchase price compared to buying all these stocks. Imagine you'll have to if you have to buy Amazon, Microsoft, Apple, and all that. Like you will have to shell out like thousands of dollars to build a simple diversified portfolio. Even that will not be so diversified because you're buying only a small quantity. You want to really build a really diversified one, it would probably go into hundreds of thousands of dollars. So, it's a good low ticket solution for people who are looking for income investing product. And there are other points that they have mentioned that you can hold it in a Canadian trust and all that. And 25% leverage is the important point that I want to emphasize. Because of this leverage, you are able to get higher income and higher growth. And 25% leverage is more reasonable. It's not going to hurt a lot. When you have positive returns, the returns are going to be 25% more or enhanced. Whereas if the returns are negative, again, the negative returns are also going to be enhanced. So leverage cuts both ways. So it's like a double-edged sword. So you have to be careful on that. But overall, if you're investing for the long term in a diversified basket of blue chip companies, so it's pretty good. So that's about the Harvest, uh, fund. Let me go down and see if there's more information on that. Yeah, we are talking about only the Canadian fund. They also have the US version, which is the high income shares fund, the US version. But this one is the Canadian one. It was launched in August 2025, and max flight level is 50%. Management fee is 40 basis points, and yeah, latest distribution is 16 cents. Yeah, those are the basic information about the fund. And you have these 10 companies like all these Shopify, Suncor, RBC, TV, Bell, Telus, and so on. So all these are blue chip companies, so you don't have to worry about where the investment is going. It's a medium risk according to the fund. So that is about the HHIC fund. Let me now move to, and this fund is paying distributions monthly. Okay, so there you have it. These are the salient features of this fund. The fund was launched recently in August, so I would not uh, put too much emphasis on the uh, performance at the moment because it's a recent fund launched a couple of months ago or 3 months ago. So you'll have to wait and see how the performance pans out in the next year. But this is a good fund to look into in 2026 and to research and keep an eye on this and see how it does. And then you can take a call on that. Now I'll go to the CANY fund, CANY. Uh, the name is pretty interesting. They have CAN Y, which is the Canadian Yield. Um, Evolve Canadian Equity Ultra Yield ETF. That's the name of the fund. And in case of Evolve, they are using this Ultra Yield as a kind of platform or a brand name for these category of funds. And Of course, they have many other income funds, but they have put this two funds, CANY and BIGY, Biggie. BIGY is the big US companies into ultra yield category as a special category for high income, high leverage funds. So yeah, so basically this is for high monthly income and also on leading companies with ultra yield. Let me go to the price is around $25. Let me go to the brochure and so that we can look at the complete details and understand what the fund is all about. Okay, we have the okay. You can they have put the Biggie and Canny on the same page. I will focus on the right side. On the right side of your screen, you have the ticker CANY, which invests in the blue chip Canadian companies. And the fund was launched September 2025. Again, it's only a couple of months old. The interesting thing is they have a similar strategy. They write about 50% of the fund. Covered calls are written on about half of the portfolio, roughly 50%. There's a slight twist here. House says that they will write up to 50%, which means they have the flexibility to reduce it or change it accordingly. But in the case of Evolve, they are saying that it will be approximately 50%. Uh, Although they have the flexibility to dynamically change or make modifications. Uh, from what I heard and from what I observed and what I heard in the interviews online, uh, the Evolve Fund Management described that they would be trying to do it approximately at 50%, not too high, not too low, because at 50% they would be able to get the best of good income and good yield as well. So this is what I understand, and there are a lot of funds which do strategy like this, like Evolve, and which is fair and which is decent. You're balancing out income and the growth. You don't want to have uh, lower income just because you want to show more growth. At the same time, you don't want to have a very high yield and sacrifice the growth or the NAV stability. So yeah, that's a decent strategy. The difference here we have is in the leverage. This fund is also leveraged, but you have a higher amount of leverage. It's 33%. Compared to Harvest, this one is 33%. So it's a little higher, in terms of the leverage. And yeah, they also have like 10 stocks, 10 Canadian stocks. The mix of stocks could be slightly different. We'll go through that now next. Yeah. And the other interesting part is like the distribution frequency is twice a month. So instead of paying monthly distributions, Canny is trying to do it a little different. They are doing uh, kind of twice a month. You can call bi-monthly, but it's more like twice a month. Like basically they would pay middle of the month and end of the month, roughly. Yeah. So everything looks good. Like the format is similar, and management fee is also kind of similar, 40 basis points. I have done a quick comparison of these two funds. I will show you that, and probably I'll also share that one page document where I made the comparison. But I don't think it's very complicated. Like if you understand one of the funds and look at the second one, and then you look at the third or fourth, it's going to be the same kind of format. But you need to understand that what is the underlying asset, what are the underlying stocks that you're investing in, what are the underlying sectors you're investing in, and what kind of strategy the fund is following. That is going to answer your question of whether the fund is good or not good. Okay. Yeah, focus will be on Canada and it's eligible for all these registered accounts. You can also, go to the website and double check all this information so that you're sure that you have the right kind of fund for the right kind of account, and also check about the tax applicability and all that. Okay, now we have seen both funds. Let me quickly go through the portfolio. Like it's not that different. TD, BMO, Brookfield, CP. A few names I see are different. Thomson Reuters, for example, and Chemical. So they have a little diversified basket of holdings. And while we are speaking, I also wanted to mention that there was a third fund from 9 Point, ECHI ETF, which is also into the same kind of space. They are also cracking big time into this high yield space. I'm going to do a video on that in the next, upcoming series, so that we can cover all this. It's pretty interesting that in Canada we are going to get a lot of these high yield space, a lot of funds, a lot of new offerings coming up, and there's no rush to buy anything because you do your research and pick what you like and what fits your goals and your risk tolerance. So even if you miss the new funds, nothing to worry about. Like there are more funds coming up, and there are existing funds which are performing really well. Some of the older funds which are champions, which are stalwarts in their own space, they're doing well. So you don't need to hunt for the new funds. That's something I wanted to mention. Okay, as we go into the last part of this video, I wanted to share a few quick things about the comparison. You will find the comparison like it's almost similar, like it's not much different. Okay, HHIC is from Harvest, CANY is from the Evolve. Uh, HHIC was started in August and this was in September, just 1 month difference. And management fee is similar. And both are looking at the top 10 Canadian blue chips. The stock selection may vary a little bit, but yeah, but it's more or less the concept is the same. Investing strategy, hold blue chip stocks, write covered calls for income, use leverage to enhance the income. Uh, the model or the concept is similar. The amount of covered calls return, the extent of covered call return, that varies. The extent of leverage being used, that varies. So here, covered call, writing is up to 50% for HHIC, and in CANY they do approximately 50%. So they do approximately half of the portfolio in terms of call writing to generate a consistent level of income. So CANY wants to bring you that consistent income every month, or probably they want to increase it over time. Like they have the certain mandate. And whereas if you look at the leverage side, HHIC is about 25% leverage. CANY is 33% leverage, slightly higher, which is also going to give a kicker returns on the positive side. Yes, there is a risk factor to that as well. So all these information that I've gathered is from the respective funds websites. So if anything changes and anything you want to check, verify, always make sure that you go to the fund website and check and you know fact check all the information that I'm presenting here so that you can understand on your own how the fund works, how this fund is suitable for you. So overall, what I would say is if you're someone who is looking for a more safer bet in future, like I'm not saying you need to select these funds. There are many more options. Like if you are selecting these kind of funds, you are looking at the overall basket. So this is for a conservative investor or moderate risk-taking investor. Whereas if you are more aggressive, uh, you may look at other funds. However, CANY is also suitable for aggressive-oriented investors. I wouldn't say super aggressive, but I would still say aggressive because you have 33% leverage and they're going to write calls on 50% of portfolio, which can actually impact your NAV, like it can go up and down more compared to the HHIC. However, it doesn't mean that HHIC is better than CANY. Like I'm just telling you the difference so that you understand the mechanics around it. So depending on what you like, you can choose, the funds. And if you're in Canada and you're looking for an income-oriented investment, and you don't want to hold too many stocks, too many ETFs, I mean, you can hold just one of these, and then your whole Canadian portfolio is almost done. One fund can actually give you the exposure to the entire Canadian market. I'm not saying the entire market, like basically the broad market exposure. But you can also have other funds to, complement that. So I would say these are two funds you can look into in 2026. Do your analysis and also share your comments or feedback. I'm going to cover these funds in future and see how they do. And I don't know if I'm going to add these to my own portfolio or not. It's still early to say anything about that, but I will keep a close watch on these at least for 6 months, till February, March, and see where they go. And then, we can look at them once again and, share our thoughts. So if you have any other ideas, any other, thoughts on these funds, please share them below. And I'm also going to share this, you know, comparison document so that you can refer to it. I hope you like this video. And if you like watching this, and if you want to see more content, please subscribe to the channel and also hit that like button. And have a great day. Happy investing.